Accounting and accountancy were both in use in the United Kingdom by the mid-1800s and are derived from the words accounting and accountantship. The verb to account had the form accounten. In Middle English, used between the 12th and late 15th centuries, which was derived from the Old French word accounter, which was related to the vulgar Latin word computere, meaning to reckon. The root of computere is putere, which means to prune, purify, or correct an account. Thus, to count, calculate, or think. The term accountant comes from the French word compter, which comes from the Latin word computere. It was previously written in English as accomptant, which was always pronounced by dropping the P, and gradually changed in pronunciation and orthography to its current form over time.
Definition of accounting.
The following are the three widely accepted definitions of accounting.
According to American Accounting Association, accounting is the process of identifying, measuring, and communicating economic information in order for users of the information to make informed judgments and decisions. According to American Institute of Certified Public Accountants, accounting is the art of recording, classifying, and summarizing in a significant and monetary manner transactions in events that are at least in a part of a financial nature and interpreting the results. The Accounting Standards Council see accounting as a service activity. Its function is to provide quantitative information about economic entities, primarily financial in nature, that is intended to be useful in making economic decisions.
History of accounting. Accounting is the process of tracking financial information, providing a system for recording, verifying, analyzing, and reporting on transactions. In business, the term accounting refers to the tracking of income and expenses. 4 stages of accounting history. The history of accounting incorporates 4 stages with distinct developments and processes. The first stage began in primitive times and ended in 15th century. In the most recent stage began in 1951 and has lasted to the present. Emergent. The first stage of accounting dates to the primitive days of civilization. Although historians haven't uncovered a record of accounting practices during this time, they point to the first exchange of goods or services as the likely start of some form of record keeping. This period lasted until 1494, with the publication of the first book to describe double entry accounting, a system using debit and credit entries. Pre-analytic. The period between 1495 and 1799 in the history of accounting is called the pre-analytic period. This span of time saw the introduction of some key accounting concepts. Going concern, a business's ability to stay afloat. Periodic inventory, the practice of recording financial entries at the end of each given accounting period. Money measurement, a system that records only transactions that have monetary value. Development. The development or exploratory period in accounting dates from 1800s to 1950. This time frame includes 2 key shifts in business, with the Industrial Revolution moving much of the world to a manufacturing-based economy and the emergence of joint stock companies, bringing multiple business shareholders to the table. Modern. From 1951 to the present day, accounting has been in its modern period, with the accounting methods continuing their shift to meet uniform standards. The growing demand for long-term financial forecasting led to the calls for accounting methods that accurately report current finances and project future conditions.
Accounting as a profession. Accounting is a highly specialized field. A profession is a career that requires specialized formal education before providing any service. Accounting is a systematized body of knowledge that has evolved alongside the advancement of trade and business over the last century. Accounting as a social force. Accounting was originally designed to serve the interests of the owners. In today's changing business environment, the accounting discipline and the accountant must both monitor and protect the interests of others who are directly or indirectly involved in the operation of modern business. People make up society as customers, shareholders, creditors, and investors. Accounting information or data will be used to solve public interest problems such as price determination and control. As a result, safeguarding the public interest is made easier with the help of proper, adequate, and reliable accounting information, and society as a whole benefit. Accounting as science or art. Science is a methodical body of knowledge. It establishes a cause and effect relationship in various related phenomena. It is also founded on some basic principles. Accounting has its own set of rules, such as the double entry system, which states that every transaction has two sides, debit and credit. It also establishes journalizing guidelines. As a result, accounting is a science. To do a work efficiently, art requires perfect knowledge, interest, and experience.
Accounting comprises many branches, like a large tree. Taxes, audits, bookkeeping, and financial accounting are only a few examples. However, the first thing that comes to our minds when we hear the word accounting is financial accounting. So what is financial accounting? Financial accounting is the process of identifying, recording, summarizing, and analyzing an entity's financial transactions and reporting them in financial statements.
The first thing you need to know is that financial accounting is built on one simple idea. The stuff of your business owns is equal to the stuff that your business owes. The stuff that you call your own are called assets. On the other side of this formula, we use two different words to describe the stuff that your business owes: liabilities and equity. So assets is equal to liabilities plus equity. That is what we call accounting equation. It was written down a long time ago by the Italian mathematician Luca Pacioli in 1494 in his work Summa de Arithmetica, and it revolutionized the way we record transactions. It's the foundation of double entry accounting, the theory that there are at least two equal and opposite sides to every transaction, because this accounting equation is always true. It must always balance.
Assets are valuable resources from which you will later profit, such as cash, inventory, etc. Assets can be divided into two categories. There are current assets and non-current assets. Current assets are those that you can convert into cash within 1 year, such as short-term investments and accounts receivable. Non-current assets are longer-term assets with a full value that you cannot recognize until after 1 year, such as property and machinery. Current assets.
Cash, currency, coins, and checks that a business has received from customers and other sources that have or have not yet been deposited in its bank account.
Account receivable, the total amount owed to the business by charged account customers.
Accrued income, income already earned but not yet collected, such as interest earned on promissory note issued by the customer before the maturity date of the note.
Interest receivable is a balance sheet account that reflects the interest income a business has earned, but for which a customer or debtor has yet to pay.
Notes receivable. The total amount owed to the business by charge accounts customer, supported by written or formal promises to pay in the form of promissory notes. Inventory, the purchase price of the goods that are held for sale by a business.
Supplies, the cost of value of such things as wrapping paper, packaging tape, twine, ink, envelopes, stamps, paper, and other assets of a similar nature that the business will use up in performing its activities.
Prepaid rent, rent paid in advance. Prepaid insurance, cost of insurance paid in advance.
Non-current assets. Land. The lot on which the building of the business has been constructed, or a vacant lot which is to be used as future plant site.
Building, the structure owned by a business of use in its operations.
Equipment. This represents manual or automated machine used in the business, and they include photocopying machine, computers, laptop, ring binders, laminating machine, delivery vehicles, and vans. Furniture and fixture. This represents assets such as table, chairs, filing cabinets, and display racks.
Liabilities is when you owe stuff to a third-party lenders or suppliers. These are obligation or responsibility that you'll need to fulfill in the future. Current liabilities are debts or obligations that are expected to be settled by payment of cash, delivery of goods, or performance of service within its normal operating cycle or within 1 year from the reporting date. Non-current liabilities are debts or obligations reasonably expected to be paid in cash beyond 1 year or one accounting cycle. Current liabilities. Accounts payable. This refers to open accounts, which represents the amount of money owed by the business to creditors or suppliers. Notes payable. This refers to open account which represents the amount of money owed by the business to creditors or suppliers, evidenced by a promissory note. Loan payable. This represents the amount of money borrowed by the business from a third-party creditors. Accrued expense are the opposite of prepaid expenses, also called accrued liabilities, are payments that a company is obligated to pay in the future for which goods and services have already been delivered. Salaries payable. Salaries already earned by employees but not yet paid by the business. Utilities payable. Utilities, electricity, water, telephone, internet, cable TV, etc. already used but not yet paid. Non-current liabilities. Mortgage payable. This represents the amount of money borrowed by the business from a bank or a lending institution which is secured by collateral. Equity is the amount of money that a company's owner has put into it or owns, the remaining claim against the assets of a business after the liabilities have been deducted. Equity.
Owner's capital. It is the value of the cash and other asset invested in the business by the owner of the business. Drawing. It is an account debited for the assets withdrawn by the owner for personal use from the business. Income summary. It is an account that receives all the temporary accounts of the business upon closing them at the end of every accounting period. This account is used in closing entries.